Today we'll look at the food and beverage company PepsiCo that recently became a dividend king, meaning it has paid an increasing dividend for 50 years in a row. It's currently trading at a PE ratio of 26.3 and has a dividend yield of 2.63%. The year-to-date performance has been relatively flat, which means it has been outperforming the market so far, but it hasn't come without its fair share of up and down swings. So it's been down 10%, up 10%, down 10%, and in the most recent month here, middle of June to the end of July, it's been up around 11%. In 2021, PepsiCo made around $79 billion in revenue through their various brands such as Pepsi, Lay's, Gatorade, Doritos, and Cheetos, and more, as you can see on the screen here. And from that revenue, 32% of it comes from PepsiCo Beverages North America, 25% from Frito-Lay North America, 16% from Europe, 10% Latin America, and other regions, and Quaker Oats have less. And if we turn to operating profit, Frito-Lay is almost at half of the operating profit, or at 44%, while the beverages dropped down from they were 32% in revenue and they're only 19% of operating profit. So we can see that the snacks and the chip side of Frito-Lay has way bigger margins than the beverage side. And if we look at the bottom two graphs there, we see 55% of the revenue comes from convenient foods and 45% from beverages, while 56% of the revenue is from the United States and 44% outside the US. Now let's look at some financials and key ratios, and we're over at the income statement here. And what I'm looking at is just to get some slow and steady growth. It's a consumer defensive stock, so you can't expect some fast growth. It's just selling essential products, basically. And the revenue here, as we can see, it's just slow and steady, even down a little bit here, but in the recent years, it's been trending more upwards. And if you look at the pre-tax income, see 10 years ago it's 8.2 billion, last year 9.8. So slow and steady. Of course the income has a little bit more of a variance to it. And we can look at the shares outstanding, and they've been buying back shares consistently, but not at a rapid pace, just very consistently buying back 1-2% every year of their shares, providing value in that way. And finally, on the income statement, we can look at the dividend per share, which is probably the biggest part for PepsiCo, because like I said, being a dividend king now, paying an increased dividend for over 50 years, and the dividend growth is in this steady, mid single digits up to lower in the lower teens. So that's a solid dividend growth, and the free cash flow per share has been covering it nicely over the past 10 years. And we can jump over to some key ratios now. For the ratios, we can switch to quarterly numbers to get more data points. We can look at the PE ratio it's been trading at for the past 10 years. It's around 17 to 30, basically the range it's been trading mostly at. And currently at 26, it's on the high end of that, so maybe not the best value currently. And the price to sales, same story, it's trending upwards and currently at a 10-year high of almost 3 price to sales. Debt to equity is let's take a look at debt to equity here. So trading at around 1.3 to all the way up to 4 in the past 10 years. They've been getting the debt down in the most recent years. Of course, it's a very capital intensive company, needs a lot of money to make money. So a debt to equity ratio of 2, I think, is not too bad here. Current ratio close to 1, which means that they can match their current assets to their current liabilities. A company as big as Pepsi, I don't think we need to have any worries about it being below 1. It's very close to 1, and we can switch back to annual here for the dividend payout ratio. So the dividend payout ratio never goes above 100%. Of course, PepsiCo dividend king. They know what they're doing here. They're paying out around 50% to around 75% normally. And in the past 12 months, they've been paying out 65%, which is a very healthy payout ratio. And now we can jump over to the valuation. We can look at these three cases I've prepared beforehand in the simple discounted cash flow model. The value creation from PepsiCo is the dividend per year, and currently they pay out $4.6 per share this year. And for the growth rate, I assume here for the normal case is 7% for both 5-year periods, 7% in the next 5 years, and 7% in years 5 to 10 or 6 to 10, which is just in line with their last 10 years dividend growth rate. Discount rate 15%, that's a double every 5 years, and stock price. Terminal multiple, I use 37, which would mean that the PepsiCo stock would be trading at a 2.7% yield, which it is currently trading around, and that brings us to an intrinsic value of $109. And what that means is we can't expect the 15% return from PepsiCo, and if we try to match the current market valuation to the intrinsic value, we get around 9% would be the fair value, or the fair rate of return to expect from PepsiCo for this normal case. The best case, I bring the growth rate up to 10% for both 5-year periods, and I bring the terminal multiple up a little bit, so it would be trading at around 2.5% yield, and for that we get an intrinsic value of $143, so still a little lower. But if we try to match the discount rate to the current market valuation, we see that maybe around 12.5%, 13% discount rate or rate of return is expected for the best case. And for the worst case, the growth rate is down to 4%, and the terminal multiple is 25, which would mean that the yield would be 4%. And as we know that if the yield is going up, the price is going down. So an intrinsic value of around $70 there. And that would only mean about less than 4% yearly return, around 3% yearly return for the worst case. So in conclusion, the normal case for PepsiCo is probably around 8, 9, 10% return per year if these assumptions hold true. And as always, this model is just made for entertainment and educational purposes only. It's not any financial advice, and the model is only as good as its assumptions, and we have to keep updating the model as we get new earnings and new information about the companies. And if you like the video or have any suggestions for the next evaluations as you do, please drop a comment and subscribe if you enjoy the content, and I'll be doing more in the future. So thank you and bye bye.